Hello, everyone. We're live here, Season 3, Stable School podcast in Cannes. I'm your host, Raza, Head of Growth at Scroll, and I'm here with Sébastien from Steakhouse Capital.
Super happy to be here. Let's do it.
Let's do it. Sébastien, take it away. Can you do an introduction of yourself and tell me more about Steakhouse Capital?
Yeah, sure. Sébastien Derivaux. I'm the co-founder of Steakhouse. So Steakhouse was a company created 3 years ago now, but have deep roots in Maker. We are working in the Maker environment, which is not called Sky, since 2020. And what we created at Maker, and now we are trying to continue to bring to the space, is our TradFi expertise. We were kind of the first one speaking in balance sheet, those kind of funny terms, and also all things related to real world assets. And we are kind of stablecoin geeks. So we are started with Maker, we then worked with Lido, ENS. We are working with a lot of stablecoin issuers. We started to create pools on Morpho. We are now the leading curator on Morpho, a lending protocol with a 700 million of assets in our vaults. And we just announced actually that Steakhouse has launched or helped launch Grove, which is a star from Sky. So Sky is the issuer of USDS, as most people know. And now they are making stars, or difficult to say what it is exactly, but subset to manage, to decentralize even a bit more, to manage the balance sheet of Sky a bit differently. And so Grove will be bringing institutional credit to the Sky ecosystem.
I definitely want to tap into, like, when you say credit. I think that I've heard it a lot here at Stable Summit. Like, I heard, to be very honest, I hear it a lot every time, like over collateralization versus credit. And we'll get into that. But what is the mission of Steakhouse Capital? If you'd like someone who has never heard of it.
Yes. So Steakhouse, the real mission, and since the beginning, it's to bring open and transparent finance. We really think that TradFi is great, but with the blockchain, we can bring more transparency and openness. And I think both of those qualities are super important. And so that's what we are trying to build, is to take the whole TradFi, move it on top of the blockchain to bring transparency and openness.
And so, immediately when I think of transparency, I think about the rise of all these stablecoins, and they have different levels of transparency. They all have, like, they're built different. And just taking a step back, from your point of view, when you're like, I love DeFi, I love all things stablecoins, this world is different from TradFi. How do you see the rise of stablecoins? Many stablecoins good or bad? Like, what's your general take?
So like everything, I would say it's a process, it's a journey. Obviously, when you start something from nothing, you don't have the tools. For instance, when at MakerDAO, we started to explore the real world assets. There wasn't BlackRock coming, because BlackRock was like, no, we don't touch crypto because it sounds super shady. And what even are you doing? There is nothing like what we are doing. So no, we are not touching it. So you need always to start small and iterate to improve over time. So I think, and even if you look at the stablecoin, like for instance USDC, which is one of the main ones, but USDT has the same journey. They started to have a lot of more risky stuff on their balance sheet, and now they migrated to have just money market funds or T-bills. So now USDC is way more safer, and we see they learned also with SBVs that banks could be a risk. So it's a process, and you need to have the right risk at the right time. So when you started on Ethereum, let's say 7 years ago, even if you have a stablecoin that is a bit more risky, but you are still using blockchain technology that is also super risky. So it doesn't matter if the stablecoin is a bit more risky, because there is so many risks already.
So you're saying the relative risk is way less with stablecoin.
Exactly.
So what you're used to in terms of risk, right, is so high that when stablecoin risk seems actually much lower.
Yeah, exactly. You can take a bit. You should always take the risk in a holistic way. Yeah. Like, if you are not even able to keep your keys, you shouldn't care too much about the risk of the asset you have, because, well, if you are losing your keys, it doesn't matter if the asset is safe or risky. Yeah. You have lost it. Yeah. So you should always focus on what is the biggest risk you are taking, and then trying to optimize. Obviously, at some point, we need to be even better. And there's a lot of discussion about, those fiat-backed stablecoin, MiCA or Genius compliance will be safer than banks. Yeah. So that's great.
Yeah.
Obviously, not everyone agrees with this statement that they will be safer than banks, but that at least is my statement. And that's great, and we should move into this direction. But obviously, 7 years ago, it wasn't super important to be safer than banks.
Yeah.
Because the whole ecosystem was super risky.
Yeah, but and we're going on a tangent here, but I actually like this a lot. But when you then look at stablecoin adoption, net new users, net new capital, they're not used to blockchain risks, but they see stablecoins. I was talking to my sisters like a few weeks ago, and she's like, "What's a stablecoin?" And just explaining that took me a minute. And then even then, I could tell she was still like, "So it's still crypto."
Yes.
So do you think that, like, we see a massive rise in adoption of stablecoins, and I also think that it's from net new users and net new capital. What's your take on how appealing stablecoins will be for the general public?
I really believing in the mullet thesis, meaning you have a fintech on the front and a DeFi on the back. I think for most people, they will not have to care about what is a stablecoin, because it will just be in their phone app with, well, I have $10. And it is a stablecoin. I can send it to another address, but maybe I don't even know what those address OX something means.
Yeah.
And I don't need to care.
So you're saying it's going to be completely abstracted away?
For some people, and you will have the option to choose what kind of complexity do you want. Some people, probably like us, we are super fine using a Gnosis Safe to store the funds, and for payments, we just send the USDC or the stablecoin to each other. Some people will need to have a nice app that is abstracting all those complexities, that will use a stablecoin infrastructure provider to send and make payments. And they will not care about the underlying part of all those complexities.
Yeah.
So it will be really opt-in, which is the difference between the system currently, which is you can only touch the highest level of abstraction, but you cannot go deeper.
Yeah, that makes sense. Coming back to Steakhouse, you guys work very close with MakerDAO. Can you tap a little bit into that, some of the revenue optimizations that you guys do, the value offering for the general public?
Yeah, so we started at Maker since, let's say, Webroot in 2020. And at the time, or just quickly after, you need to remember that interest rates were 0% in the real world, or close to 0%. And a lot of people wanted to hold the DAI, which was a stablecoin at the time of Maker Sky. And so there was not enough collateral. And so Sky at some point had 5-6 billion of USDC on its balance sheet. So first, understanding, well, why do you want to have a USDC exposure? There was a lot of drama about, well, you are just a USDC wrapper. But especially the issue is that it wasn't generating any yield. So then we tried to work on what we call real-world assets to find out how can a DAO, which is only living on the blockchain, can invest in real-world assets.
Off-chain.
Off-chain, yeah. So we started to work with some proof of concept, if you want, which were on private credits. Then the rates started to rise again on the T-bills front, up to more than 4%. And then we tried to work with all the lawyers. It's actually super complicated to move money that is on-chain, off-chain, make legal entities and so on. And we help a maker to invest up to 2 billion in T-bills.
Wow.
And more recently, we migrated those off-chain investment to on-chain investment, which are called tokenized T-bills, with the Spark Grand Prix, where Maker invested, I think it's 1 billion, to Bridle and other tokenized T-bill issuers. So it's more transparent in a way, because previously it was off-chain, now it's on-chain, and anyone can look at the addresses and you can see how much of those tokens there are. Obviously, the tokens themselves are a representation of an off-chain fund, but it's managed by BlackRock, and it seems that in crypto, everyone is fine if BlackRock is managing money.
So are you guys looking at new stablecoins or doubling down on existing stablecoins? What's your strategy there?
So we try to not have a specific view on stablecoins. In the sense, we don't want to favor some stablecoins instead of others. We kind of work with most of them, actually, so it will be impossible anyway. We can have competition. I don't think it would be great if there is only one stablecoin that is winning, be it USDT or USDC. I think we like the free market competition that will create more innovation. If it's only one stablecoin, let's say USDT or USDC, becoming the main one and the only one to be used, I mean, we can call it like a CBDC, and that's way too much power to one private company.
This is, again, a complete tangent. I'm just spoke to so many people. I've been to Nigeria, Lagos recently, and I've been to Nairobi, Kenya. Spoke with a lot of people on the ground, but also like, you know, online. I see a huge movement towards USD-based stablecoins. Do you think that's a concern?
Concern in which way? What are the concerns you think?
That there's a lot of emphasis on the dollar.
Yes. So, in one way, you can say, well, the dollars, no matter what you think, for some people, it's better than the currency as they have. Obviously, there is a lot of talk about dollarization of some countries, and I think that will happen. Is it really a bad thing? I'm not sure. There are some countries that have currency board with the US dollar for the last 50, 100 years. It doesn't look like it's a big problem. Obviously, if you go in depth, you can have a more elaborate discussion, but people will find solutions to their own problem, and I think that's good that they have the option to find their solutions. So I'm from France, so I would love to see a bit more the euro, and I would love to see more regulation friendly in Europe to promote the euro instead of trying to promote their CBDC. But currently, the euro is not winning. If you look at the blockchain, it's less than 1% of the stablecoin.
Yeah.
But we are trying to work in this direction as well. I think having many currencies will be quite interesting as well on the blockchain. But we are not there yet, and there is a lot of discussion about how can we make FX conversion more efficient on-chain than off-chain. So that will be a very interesting research area. But yeah, we are not here. So it's a US dollar. I wouldn't see a problem for now, but we need to be better along the way.
Yeah. I definitely share your concern. Born in the Netherlands, I would love to see more here as well. Also, just like, I think Monerium's doing a great job.
Yes.
Just like the integrations and bringing people on chain. It's not just currency volatility that stablecoin brings a use case. That's a lot more. I think that coming back to, you mentioned about the yield strategy for RWA. How do you make sure it's sustainable? Because you mentioned T-bills, and what is next, or sort of like, yeah.
So if you look at DeFi as a whole, since let's say 2020, 2022, the whole point was always to find new sources of yield. When it started, let's say 2020, it was what I call crypto-backed loans. You put some crypto collateral, let's call it ETH, and you can borrow a stablecoin. So that was how DAI was started. You could only put ETH as collateral and borrow DAI, which were minted. You had a lending protocol like Compound or Aave. They were doing the same stuff, but you needed other people to deposit their stablecoin. So that worked great, except when there is a lot of people that, when the prices are going down on crypto, strangely enough, no one wants to have leverage on crypto. So no one wants to borrow. And then you have the issue that the rates are coming down, because a lot of people are not trapped, but wants to remain on-chain with a stablecoin. They want to get...
just to clarify what you said, strangely enough, no one wants to borrow when crypto goes down.
Yes, because the main use case of crypto-backed loans is, well, I have a view that ETH or Bitcoin will go up. I will put some ETH collateral. I will borrow a stablecoin, sell the stablecoin to buy more ETH, put it as collateral, borrow more stablecoin, and so on. So the idea is that those people will take 2 times or 3 times leverage on ETH or BTC. And obviously, you just do this because you think, and you will pay an interest, let's call it 5, 10%. But you can only do this if you think that the underlying cryptocurrency will go up.
Yeah.
And the markets, what we see usually is that the borrow rate on those activities depend on the movement of the price of cryptocurrency for the last 30 days.
Yeah.
So if crypto goes up, funding rate or the cost to borrow stablecoin will go up. If cryptocurrencies are going down, the cost of borrowing crypto stablecoin will go down. So for instance, during the last bear market at MakerDAO, you were able to borrow at 0% or very close to 0%. So that's not great. And so that's why all those, a lot of people were trying to see, well, in those cases, what can you do to still have an organic yield? And then you saw what we did at Steakhouse to help Maker and others to invest in T-bills, because T-bills rates were better, up to more than 4%. Then you saw Ethina, which started a few years ago, 1 year ago actually, where they invested in the basis trade. So what is a basis trade? Is they were going long as a cryptocurrency, but selling the future or the perpetual future on some exchanges. And this funding rate was a source of yield. Now that came down a bit, because obviously they put money into work. It was more than 2 digits at some point, but now that there is more capital into it, it's going down. The next wave of adoption will be most likely private credit. You see Apollo Capital coming. We also launch with Arcred. We also launch something with Midas and Fazanara, which is called MF1, that you can borrow against, or people can have exposure. So those are a bit more risky products. They are still a bit complicated. It's still early. But I think the trend is ready to bring all the sources of yield that you can, and people will optimize or move from one to the other depending on the environment. So when crypto-backed loans will be more than 10%, people will remove their money from money market funds or T-bills and put it into crypto-backed loans. When there is a basis trade that is better, they will move to the basis trade and so on.
With this rise of like yield destinations, what do you think will facilitate users to make the best decision, but also like what role do you see Steakhouse Capital playing there?
Yes, I think for most people, they will go through aggregators, and I use this term quite broadly. So for instance, you can invest in the basis trade. There are some tokenized versions. So you can invest in a Bridle. I mean, you need to have 5 million, but there are other alternatives like Superstate, Tondo. There is a full set of providers of money market fund where you can get those 4%. But then you need to shift from one to the other. You need to perform due diligence. For some people, it's just more easier to, let's say, invest in SUSDS, so the saving stablecoin of Sky/Maker. And Maker, underneath, will define how to allocate to the best risk profile. And so you will have both the option to have yield aggregators, or even if you invest. For instance, we are managing Morpho Vaults. You can invest in Morpho Vaults, and you try to optimize as well in this direction. But you can also invest directly in the Morpho markets, which are underneath, and define your own allocation. What I really like about crypto, and I think it's part of the ethos of crypto, is that you have many options, but you can choose which one is best for you.
So how do you? So what is Steakhouse Capital's like risk framework? And then how do you communicate it adequately to create trust?
Yeah, that's a good question. So what we are looking for is, so you have always plenty of source of risk. You have smart contract, you have market risk. So let's say, for instance, when you lend against ETH, you are not making so much risk on the ETH component, because ETH is native on Ethereum, so you're not taking much risk there. But you are lending against ETH, and if the price of ETH goes down too fast, then you can create some bad debt, so lose some money, more or less. And so that's quite bad, obviously. And then you need to analyze what is the buffer you need to ensure that going down in ETH will not be too fast to prevent liquidation. So selling the ETH on the market to repay the debt. So this is also a risk. Now we see a lot of protocol issuing stablecoin, or you see the rise of Pendle, which is a term investment that you can make against some collateral. And then you have those are more counterparty risk, because you are investing in something that is managed by people. They have some admin rights on the smart contract. Sometimes you can upgrade the smart contract. So that's more a counterparty risk in the sense of you need to analyze properly what can those people do, or even if it's a DAO, the DAO can upgrade the smart contract. Is there a time lock? Those kind of questions. And also, obviously, you have Oracle risk. Most people are depending on Chainlink or other Oracle provider, which are coming from the off-chain. So there is always a risk there as well.
So what yield source or exciting yield sources do you see like on the rise right now? Combine it with like, I don't know, to just like throw a buzzword in about risk-adjusted yield. So what is a source of yield where you say this is credible, it's exciting, it's new, that you're seeing right now?
Yeah, so as I said, I think private credit will be the next wave. It's still risky. I mean, again, risk depends if you are investing in Pendle, on a Pendle managed by a team that just launched a protocol 2 days ago that is audited, but you can always have some configuration issues and whatnot. Obviously, that's probably more risky than private credit managed by Apollo. But still, there are risks. So yield is good there, but at the same time, it's a lift for crypto people to start to understanding this new risk. What does it mean? You are, for instance, on Apollo, you are making loans to companies. It's a portfolio of loans, CLOs. What are the risks? How to think about it? You need to understand the price can fluctuate, and it will fluctuate. If there is a crash in the markets, that will have an impact. So you need to understand those kind of risks.
How do you do long-term planning for yield? What I mean with that is, let me specify, is I personally always get the feeling, how long will this continue? I think that if you're a bit savvy, you move your portfolio around. I mean, I'm very risk averse, but even then I'm catching 25%. But I'm also wondering, like, how long was it? How long? I feel like I need to educate myself continuously to make sure I'm on the latest trend. Where do you think the possibility end, or will we get into a stage very soon where you just have to, like the banking system right now, like in a saving account you get, I don't know, 2 to 5%. You have to be very, very happy with that if you get that. Do you think we're there anytime soon, or?
So if you look currently in the markets, people chasing those 20%, it's still a small subset. And usually when you get 20%, that is with low risk, I would question the low risk part, because there is always a lot of risk. Because there are new protocols usually, so you are taking some chances. But what you are doing is, yeah, those new protocols are starting. They are giving you points, token, rewards. You can swap the rewards or the points on Pendle, invest in Pendle, and then you get the yield because you are financing people that want to chase the point and token. So in some ways, you are farming VC money in a way, or maybe not VC money, but the token, or people want
speculation. There's a lot of speculation.
Yeah, you are farming speculation.
Yeah,
to convert it to an actual
for
yield.
Sure.
So that works very well. But currently, what is the size of money that is chasing those opportunities?
I mean, I think we've reached upper limit now.
Yeah, I mean, it's a few billion. Pendle is a few billions, and rates now are coming down. It was easy to have more than 10% a few months ago. Now it's more 7, 8%.
I mean, if you look at the entire market cap of stablecoins, I think it's 250 billion right now, but that's like, I don't know, 160 or something is USDT, and then like 60 billion is like, I don't know, UCC, don't catch me on the
And a lot is not used currently in DeFi.
100%.
That's, I mean, it's just a tiny part.
Yeah.
So it's let's call it a few billion.
Yeah.
A few billion is not much.
Yeah. So, well, I mean, Ethena is 6 billion. And then you do have like, up and coming protocols like Resolve, like I think they're 300-400 million now, but it goes down very quickly.
But you don't get 20% on Ethena today.
Yeah. Yes. 6% now. Last
yeah, 6%. I mean. And if you look at Ethena, they started a lot. There was a lot of discussion about, Ethena is not a stablecoin because it's
synthetic. Yeah.
Synthetic dollar or structured product.
Sure.
But okay, if you look at the balance sheet, it was mainly invested in the base trade, source of yield, great execution, great timing, perfect on that front. But currently, or at least last time I checked, maybe a few months ago, it was 80% money market fund. So if you look at the balance sheet of Ethena or Sky, it's not the same, but the direction is exactly the same. I mean, mainly money market funds and some a bit more risky asset. And you have a buffer of equity to protect the stablecoin holders. So things are evolving. And again, even Ethena, they dried up the source of yield on the basis trade. Now they invested in mainly Beetle. Yeah.
If you could, where do you think the biggest unlock is for growth in stablecoins today?
Really finding actual people to use it to do a real business. I mean, that's why USDT is growing quite fast, because there is a lot of traction and actual people using it. I know there is still a lot of people adopting that USDT usage on Tron is real, but I think it's real. I look at the data. I have some anecdotal evidence that people are using it. So it sounds like it's real. But yes, finding people in the real world to use it. For instance, at Steakhouse, we are crypto native, obviously, and everyone is paid in stablecoin. So some people will keep the stablecoin on chain. Now we have a lot of credit cards that can use a stablecoin. So
yeah, we have one on Scroll, ETFI Cash.
Exactly, yeah.
You just like that's like only available on Scroll. You basically deposit it in a liquid USD vault. So your stablecoins are working while they're sitting there, and when you want to spend them, because that's like not the most common pattern in stablecoins. People want to hold on to this thing because your money capital is working for you.
Yeah.
But if you want, you can.
Exactly, and that's a good use case because you provide a bit more yield. I mean, there might be a bit more risk because it's still new and so on.
Yeah.
But for some people, it's just fine, and they just have an app and a credit card. And
I like what you said before. It's all relative, the risk, because for someone who's crypto native, that still feels like very safe. As in, like, okay, I'll put my money in a vault with a trusted brand, and then at least I get to spend it whenever I want, you know. And that feels like almost a true promise of crypto, right? Because your funds are on a network that, let's say, you know, can't go down, and it's there, and then it's working for you, and yeah.
You know, there is a funny story at Steakhouse. At some point, we had to move money from mainnet to Base to do some operations. I don't remember exactly which one. It was I think it was CBBTC. I don't remember exactly, but we were like, well, we have two options. One, we need to find a bridge, but it was complicated. It was super early on Base as well. So we needed to call a smart contract with Etherscan, you know, doing all those complex stuff that you can mess up easily. Or we can send to Coinbase Prime and just use that as a bridge. And we're like, at the end, we decided to do it the hard way by calling smart contract and all that, you know, giving parameters that, well, is it correct, is it not? Because we just thought, well, if we send to Coinbase Prime, it was a sizable chunk of money. They will most likely freeze the account to ask more KYC ML stuff, and we will lose a few days. And we didn't
maybe
have
even
a few
worse.
days. Even worse, maybe, you need a KYC refresh. We need to have a notarized document, so I will have to drive my car to go somewhere to notarize my documents, to scan them. I mean, it would be a lot of work. And so for real people or TradFi people, we choose a risky path, but for us, it was less risky than going to all those, the kind of risk of being frozen for even a short period of time.
You know, coming somewhere over the end, I have two more questions for you. Is, you know, what are some of the innovations that you're seeing where you're like, hey, you know, this excites me, broadly speaking, obviously looking at the stablecoin space, where you're actually implementing it or making it a part of your strategy at Steakhouse Capital?
Yeah, so what is really exciting me, and it's funny because it was exciting me in 2020 as well, or 2021, is creating the yield curve. So what is a yield curve? It's a TradFi concept, meaning that currently, if you go on Morpho, RVA, Compound, you are borrowing at a variable rate for 12 seconds. Every 12 seconds, the rate can change, and it can go up or down depending on the market. But it doesn't work like that in TradFi. Usually, people are borrowing for a fixed term, or at least a fixed rate, for 3 months, 1 year, mortgage are 25 years. And currently in crypto, it never worked to go longer term than one block. And variable rate, it's a bit more complicated, but let's call it just what we call usually overnight. You are borrowing for a very short period of time and the rate can fluctuate. And no one really had found a way to solve this issue. But now we have more and more institutions coming to borrow in DeFi. The borrow on DeFi is now bigger than borrow on the CeFi. And they need more term product, more stability on the rate. So I think it's the right timing to provide this opportunity. And if you look at Pendle, which I think was the best real world or TradFi invention lately, even if it's mainly on speculation and points and so on, it was providing a product market fit to see that while people want and are able to lock capital for 3 months to get a yield. And so that's what we are working on mainly with Morpho V2 coming very shortly, where the curators will be able to provide loans for a given period of time, call it 1 day, 1 week, 3 months, 1 year. And I think that will completely unlock a lot of issues. We are speaking, for instance, a lot with some Bitcoin layer 2s. And what they are saying is that, well, our user base is quite different than DeFi. In DeFi, people are borrowing, let's say at 3% or 5%, and they are using it to farm a yield opportunity at 20%. But they don't know what is the length of the time the yield opportunity will stay. So what they are making is a spread. But they want to be able to unwind at any time.
Yeah.
For instance, you are borrowing USDC, you are putting Ethina, earning a bit more better yield, but you want to be able to unwind anytime. So you don't want to commit for a long period of time. In Bitcoin, a lot of people are just holding on a lot of Bitcoin. They are not selling, obviously, and they just borrow for their lifestyle. And when you are borrowing for your lifestyle, you want to be sure that the rate is, let's say, 5-6%, but you don't want it to see jumping to 60%. So you want more stability, and they are more willing to borrow for 3 months, 1 year, at a fixed price.
And so, rounding up, what's next for Steakhouse Capital? Up and coming existing players. What should people be on the lookout for Steakhouse Capital?
Yeah, I'm super excited by all the work we'll do on Grove, which is a sub-DAO of Sky. So bringing institutional credit with very big names that we will announce shortly. That will be super exciting, providing on-chain facility for all those real-world assets. On the Morpho side, we are obviously excited with Morpho V2. We will launch new products that will be announced this summer as well. And again, bringing a bit more complexity. Currently, we are just a repo real-time lending protocol, but we will move to make more complex product over time. And this complexity will make DeFi, I think, even more interesting going forward, but sadly, even more complicated.
Yeah. Definitely excited to have to hear what Steakhouse Capital has on the planning. Like I said, we were talking, yeah, thanks so much for joining, Sébastien, and looking forward to pushing this one out.
Thank you for having me.